Hey everyone, welcome back to Corporate Decoder. Today, Mountain Crest Acquisition 6 Corp. MCAHU just filed its 10Q report for the quarter ending the 31st of March 2026, and I am seeing a major going concern flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company just went public and is already facing serious questions about its ability to stay in business for the next year. So, Mountain Crest Acquisition 6 Corp is a special purpose acquisition company, or SPAC. Think of it as a blank check company that goes public with the sole purpose of finding another company to buy and merge with. They raise money from investors and then have a limited time, usually 18 to 24 months, to find a target business. If they don't find one, they typically shut down and return the money to investors. This filing is their quarterly report, giving us a look at their finances from January to March of 2026. Looking at their balance sheet as of the 31st of March 2026, we see some key numbers. They had only $30,000 in cash. That might sound like a lot, but when you look at their liabilities, they had $135,420 in current liabilities. This means they owed more money in the short term than they had in cash. They also had deferred offering costs of $86,950. Which are expenses related to getting their stock offering ready. Their total assets were $116,950, while their total liabilities were $135,420. This already paints a picture of a company that is not in a strong financial position right at the start of its public life. And when you combine their liabilities and shareholders' deficit, which is essentially the owner's stake in the company, their total liabilities and shareholders' deficit came out to $116,950, matching their total assets. But the shareholders' deficit itself was negative $18,470. This indicates that the company owes more than it owns. Now, let's look at how they performed operationally during this period from the 6th of January 2026, when they were formed, up to the 31st of March 2026. Their statement of operations shows a net loss of $43,470. This loss is primarily due to formation general and administrative costs. They haven't made any money from operations because they haven't acquired a business yet. Their loss per ordinary share was $0.02. This number essentially shows how much of that net loss is attributable to each share of stock outstanding. This statement details how the shareholders' deficit changed. The company issued shares, bringing in some capital, but the net loss for the period further increased that deficit. When we look at cash flow from operating activities, it confirms their operational struggles. They used $40,420 in cash for operations. This includes the net loss adjusted for things like formation costs paid by their sponsor. On the financing side, they did bring in some cash. They received $95,420 from a promissory note from a related party, likely their sponsor. They also paid out $25,000 in deferred offering costs. This resulted in a net cash inflow from financing activities of $70,420, which helped boost their cash balance. So, after all these movements, they ended the period with $30,000 in cash. This note gives us some background. Mountain Crest Acquisition 6 Corp. was incorporated on the 6th of January 2026. Their main goal is to find a business to combine with. They had not identified or even seriously discussed with any potential target by the 31st of March 2026. This is important context. Their IPO was declared effective on the 29th of April 2026. This means they officially became a public company around that time. The IPO itself, where they sold units of stock and rights, happened on May 1, 2026. They raised $60 million from this offering. Each unit came with one ordinary share and one right, which can be exchanged for a quarter of an ordinary share later. They also sold private placement units to their sponsor and D Borrow Capital, the underwriter. Interestingly, they mentioned that the funds from the IPO and private placement were placed in a trust account. This money is supposed to be used for their business combination. However, there is a catch. The money is on a tightly controlled timeline. They typically have 12 months to find a business. If they don't, they liquidate. This next part is crucial. Under going concern consideration, the report explicitly states that the company lacks the liquidity to sustain its operations for a reasonable period, which is considered 1 year. This is a major red flag. It means that if they don't find a business combination soon, they might not even be able to keep operating. They mention mandatory liquidation if a business combination doesn't happen, and this raises substantial doubt about their ability to continue as a going concern. Think of Bed Bath and Beyond or Tupperware trajectories. Historically, about half of microcap SPACs with such warnings end up failing to meet their objectives or worse. The report also highlights global uncertainties like trade tensions and conflicts. These can make it harder for them to find a business to acquire or even affect the performance of a target company they might acquire. This section explains how the financial statements were prepared. They are following us generally accepted accounting principles. They also note they are an emerging growth company, which allows them some flexibility in reporting requirements. Like most companies, they have to make estimates about future events. The report clearly states that actual results could differ from these estimates, which is always a point to keep in mind. They confirm their cash position for the period, $30,000 in cash and no cash equivalents. Deferred offering costs are important for SPACs. These are expenses like legal and professional fees that are directly related to the IPO. They are charged to shareholders' deficit only after the IPO is completed. If the IPO is unsuccessful, these costs would be charged to operations. Interestingly, the company is a British Virgin Islands business company. They state they are not currently subject to income taxes in the British Virgin Islands or the United States and had zero tax provision for the period. This is common for companies that haven't started generating significant revenue. The rights issued with the units are a unique part of SPACs. Each right entitles the holder to receive a portion of an ordinary share later. The accounting here is complex, but essentially they are treated as equity instruments. If the company fails to complete a business combination, these rights will expire worthless. This metric shows the per share impact of the company's losses. For this period, it was a small loss per share. This section details the IPO. They sold 6 million units at $10 each, raising $60 million. Each unit included a share and a right. Simultaneously, they sold 90,000 private placement units to their sponsor and the underwriter for $10 each. This is how they also got some funding. Here we see transactions with the sponsor Mountain Crest Holdings 6 LLC. They issued founder shares to the sponsor for $25,000, which covered some formation and offering costs. The sponsor also agreed to loan the company up to $750,000 for IPO expenses, as of the 31st of March 2026. They had borrowed $95,420. The company has the option to extend the time to complete a business combination, but it comes at a cost. The sponsor has to deposit more money into the trust account for each extension, in the form of a loan. As of the 31st of March 2026, no such extension loans were taken. This part covers agreements. They have registration rights for their shares, meaning they can demand the company register their shares for resale. Deferred Capital has a right of first refusal for future underwriting services. The underwriters also had an option to buy more units, and they were entitled to an underwriting discount. Importantly, all these IPO-related fees and units are subject to lock-up periods, meaning they can't be sold immediately. This details the breakdown of their equity. They are authorized to issue preference shares and ordinary shares. As of the 31st of March 2026, they had 29,570,43 ordinary shares issued and outstanding, with some of those founder shares subject to forfeiture. The rights are also discussed here, reiterating that they will expire worthless if no business combination is completed. This filing indicates only one reportable segment for the company. Their chief operating decision maker, which is the CEO in this case, looks at the company as a whole. They focus on net income or loss and total assets to make decisions. This is a very important section for understanding what happened after the reporting period. The report states that the IPO and private placement closed on May 1, 2026, raising $60 million and placing it in the trust account. This confirmation of the IPO closing is critical context for the going concern warning. This is where management explains the numbers. They reiterate that they are a blank check company looking for a business combination. They expect to incur significant costs for due diligence and as a public company. They had no operating revenues and a net loss of $43,470 for the period, mainly due to formation costs. This section elaborates on their cash situation. Before the IPO, their liquidity came from the sponsor. After the IPO on May 1, 2026, they raised $60 million with a good portion going into the trust account. They spent $1.25 million on transaction costs like underwriting fees. The net cash used in operations was about $40,420. Management plans to use the trust account funds for the business combination and any remaining funds for working capital. This repeats the critical going concern warning. They have $30,000 in cash and a working capital deficit. Even after the IPO, they lack liquidity for a year. The 12-month timeline to find a business combination creates doubt about their ability to continue. The company states they have no off-balance sheet arrangements. This means there are no hidden deals or entities that could impact their finances without being reported. Their main contractual obligation mentioned is the agreement with the sponsor for administrative services, costing up to $10,000 per quarter. The underwriter's agreement and fees are also discussed here. The report says they have no critical accounting estimates to disclose. This is often the case for early-stage companies with limited operations. This section is not required for smaller reporting companies, so it is not applicable here. They report that their disclosure controls and procedures were effective as of the 31st of March 2026. There were no changes in internal control over financial reporting during the quarter. They refer back to the risk factors outlined in their IPO prospectus, stating there are no new material changes. This details the founder shares issued to the sponsor and the IPO and private placement sales. The use of proceeds is focused on identifying a business combination. This is a list of all the documents that are part of this filing. It includes various agreements like the underwriting agreement, memorandum, and articles of association and registration rights agreements. So, looking at the big picture for Mountain Crest Acquisition 6 Corp, this filing paints a concerning early picture. They just completed their IPO, raising a significant amount of money, but the core financial statements and the explicit going concern language show they are operating with very limited cash and a serious time crunch to find a business to merge with. The fact that they are highlighting the going concern risk so prominently so early in their public life is a major point of attention. The company is essentially saying they might not be around in a year if they don't act fast. The next few months will be critical for them to show progress in identifying and securing a business combination. The risk I am watching is whether they can secure a business combination within their limited time frame, especially given the going concern warning. My biggest concern is that, like many SPACs that have failed to execute, they could run out of time and money. What I am actually looking for is any news on potential target acquisitions in their next filing. Alright, that is my take on Mountain Crest Acquisition 6 Corp. Its latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.